Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we've been talking about the effect of the Ukraine and the Russian invasion of Ukraine and on the markets. And of course, we've got with us Phil Kosmala with Kosmala. And Phil, this is one we were talking just before the break about the Federal Reserve and what impact this might have. And I think you mentioned that the expectation, the markets kind of got baked in 0.5%. So as long as it doesn't go higher than that, of course, we wouldn't have a negative. We would expect it to be a pretty smooth sail through that. Now, if they, of course, determined, well, with this Ukraine-Russia thing, there's some uncertainty, maybe they wouldn't go up as much. Do you think there's a possibility? And, of course, I would expect that would be a positive for the market, or at least in terms of the market going up if that happened.
Yeah, Hank, I think the one thing we know is historically looking at the Federal Reserve and the path of interest rates for the past 60 years, the speed matters. Yeah, so the speed with which the Federal Reserve tightens. And right now, we've taken 50 basis points off the table. So right now, markets are only anticipating a quarter-point hike in March.
Yeah. Now, Phil, one of the things you were talking about, the concerns there, how they're going to deal with it as far as the economy, not just here, but in other parts of the world, in particular with the conflict and the impact on energy, oil and natural gas flows, and how that might impact the economies. I mean, we're already dealing with 7% inflation. So certainly this is in supply chain issues. And now we've got this in addition. It seems like that's just going to aggravate it all the more.
Absolutely, Hank. I think, we went back and we studied historically. I know a couple of the charts that we have for the show today. We went back and we looked at prior periods of geopolitical strife. And historically, markets have started to price in a lot of that angst in anticipation. And I guess the historical evidence going back to Vietnam, the first Gulf War, the second Gulf War, the Crimea invasion. In each one of these instances, the markets have basically adopted some level of indigestion 2 months prior to the conflict. And after that, Hank, you see markets respond pretty well. They correspond back to what's happening in the overall economy.
I'm going to get this slide while you're talking about this, Phil. Let's get that slide up on By the Invasion. That's kind of tying into what you're referring to right now.
Yeah. And you know what, Hank, markets hate uncertainty. And the prospect of war historically has been one of those periods of uncertainty that markets have caused. You've seen unrest and you've seen volatility kick up. Mm-hmm. But ultimately, it's behooved an investor to buy the invasion. And this goes back to several prior instances, whether it be the Vietnam War, the first Gulf War, the Afghanistan War, the second incursion into Iraq, and then the Crimea War. And it's been rinse and repeat, not just here. You can go back to World War II, Hank, and you see this same pattern. The critical thing is whether or not we're in a recession. So historically, when we've been in a recession or entering a recession and you throw the prospect of a war on top of it, that's when you've seen some subpar returns or negative returns for equity markets. But historically, I think we've seen the volatility over the past month and a half, Hank, and you articulated it's not just the war, it's the 7% inflation combined with uncertainty surrounding the Federal Reserve. And I think hopefully the good news is, at least on the Federal Reserve, we'll have much more clarity on March 16th as to the Fed's path forward for interest rates.
This is one I'm looking at the slide you provided us, Phil. We've got you see the different time frames or the different conflicts. We've got the Vietnam War on that upper left corner, and of course the Gulf War, in each of those instances, or most of them, Iraq, Crimea rather. When this was one of the things when they invaded Crimea back in 2014, that had a initial effect, but then the market, of course, climbed up after that. And even the only time it went down was probably after it was Afghanistan, and of course that was with 9/11. There were a bunch of other things. We had a recession, bear market that we went into 2000 through 2002. So a different time than what we're likely to see with. In other words, if you could, Phil, maybe comment a little bit about the economy at these different times as well, and how that compares with today.
Yeah, Hank, I think it's a great observation, because what we showed on that prior chart was the vertical line was the actual incursion. Market volatility kicked up 2 months before. So markets historically have started to sniff out the prospect of a war and a slowdown in economic activity, or a rise in oil prices and commodity prices that would inhibit economic growth. Hank. And so what we saw in each one of these examples was a resumption of the underlying trend. When the economy was in good shape, markets ultimately shrugged off the initial shot across the bow, or the fire of cannons, and we resumed back to the trend that existed prior to that period of strife. But the Afghanistan war was different, Hank, because we did have a recession. We had the dot-com bust. We had 9/11. You had the Federal Reserve tightening interest rates through the late 1990s, and ultimately that was an economy that was already in recession, right. And the prospect war at that time led to choppy results. So, and Hank, our next slide, I think it's also good for all the listeners, viewers today. If you look at it historically, going back over these periods and even looking prior to the Vietnam War, what we've seen is that these incursions, you've seen volatility the day of, and you've seen a quick response in markets, but ultimately those have been short-lived. The duration.
We can get that one up for you. Markets tend to shake off geopolitical strife in relatively short order. That one where it goes into, on this graph, we'll get this up on the screen as well. To your point too, the trending, what we were seeing was prior to the other conflicts, the markets were actually trending up, with the exception of Afghanistan when the market was trending down. So to your point, that it continued after it kind of absorbed that conflict into the mix, the market then continued what it had been doing before. And then this one, we can maybe zoom in a little bit on in particular, at the top, upper left hand side there. Talk a little bit. This is the one you were saying, how fast the markets recover after an event such as this.
Yeah, and Hank, I think this is the case in point here. The proof is in the pudding. And Mark Twain famously said, "History doesn't repeat itself, but it often rhymes." Yeah. And I think the periods where you've seen double-digit declines, those associated with war or other periods of geopolitical strife, Hank, when you've seen that, it's when we've been in recession, 2001, 1990. Those were the examples where we've seen more prolonged or more dramatic slowdowns in whether it be markets and economic activity. But if we're not in a recession, what we've seen is very short, sharp, jagged moves downward that haven't lasted very long. Right. And our economy, despite the 7.5% inflation, Hank, we're seeing retail sales and retail spending hit all-time highs, corporate profitabilities at all-time highs. We're not entering a recession as of yet, and ultimately the Fed will dictate the path forward.
Right, and that's the pace, as you've said before, of the increases in rates, how fat, not only how much they might go up, quarter point, half point, whatever it might be, but also how frequently they're going to increase and what their ultimate goal is. And there's been some, listening to a couple of Fed members, I mean, we've heard some numbers that, as much as 2% this year, I believe.
Yeah, and Hank, I think they backed off that talk last Friday. Lael Brainerd, who's as soon as she's confirmed will be the vice chair of the Federal Reserve, with Chairman Powell at the helm. On Friday, she threw a bucket of cold water on the 50 basis point hike, or the very aggressive hiking campaign. We will know, Hank, the Fed puts out their summary of economic projections at the March 16th meeting. That's where they lay out their path for the year in terms of Fed funds rates. Markets are pricing in 7 hikes. That would be 1 hike at each of the remaining meetings this year. So 7 hikes would be 1 3/4. We think with unfortunately, with the Ukrainian situation, the likelihood is that we'll see 5 to 6. So there's a decent chance that the Fed skips 1 of the remaining 7 meetings, the quarter point hikes at those meetings, and we end up at the end of the year at 1.5% on Fed funds.
Yeah. Okay. Good news. Now, one of the slides that you've also got here, Phil, is that markets tend to shake off geopolitical strife, especially when not in recession, which you were just talking about. Why don't we get that slide up, the next one there? And to your point, on this slide, some of those areas, maybe we can zoom in particular with some of those shaded areas there.
Yeah, Hank, I think this is really remarkable. And I think that if we focus on those green areas, and I realize this may be a little bit small for the viewers, but when you go back at all the major incursions going back to World War I, there have been 33 major or wars or incursions over the past 100 years. And history, again, trying to use that as a guide, Hank, because you do have to somewhat throw the playbook out when you see periods of war, at least in the short-term forecasting. But what do we know is historically we've seen really good returns, and the columns to the right of those dates are the 3-month and 6-month returns and 1-year returns. And you see a lot of green, Hank, with the exception of the red periods are where we were already entering a recession. So I think that, the 90 time period where you had the S&L crisis, the savings and loan crisis in Illinois and down in Texas and throughout the commodity belt in the Midwest. Those periods we saw down returns for the next 3, 6, and 1 year time periods. But when we didn't have those periods of economic weakness, you've usually seen markets rebound in pretty pronounced fashion if we're not entering a recession after we've had these incursions and wars.
Yeah, and you see the likelihood of a recession at this time being pretty low.
Yeah, still extremely low, Hank. And I think, I know last time we spoke on the TV program, we did see a lot of these supply chain issues were starting to get rectified. In fact, you're seeing shipping times, you're seeing delivery times come down, shipping costs are coming down. We will see that. We don't anticipate 7% inflation to be with us for the next couple of months. In fact, we think we likely see that at least recede down to a 3 or 4 handle by the fall. That would help embolden the Federal Reserve to take a more measured path on interest rates going forward.
Let's take a look. In fact, you've got the executive summary here, this Goldilocks part, the next slide with the little bell curve in there. And it really hasn't changed much, I don't think, from where we've talked in the past, right? So to your point that geopolitical uprest or what do I want to say here? Basically, the uncertainty that comes in with these geopolitical, in particular when you have conflicts, armed conflicts, and even now this one's pretty severe. It seems in terms of historically to go. When's the last time someone went in and tried to take the whole country, kind of thing, in the way that Putin's doing? And a little surprising that he this morning as you noted, that he all of a sudden is saying, well, we're going to send within 10 miles of the capital, and we're going to send in some people to talk peace. Some emissaries for that. That seemed a little surprising, and wondering, is that what to make of that? It's the markets, as you said, have reacted positively, but are they going to, if that turns into be some type of a Trojan horse, is that just going to turn, are we going to see a big drop in the market again?
Yeah, you know what, Hank, I think 10% corrections are normal in markets. We see a 10% correction about every 15 months for the past 100 years, and we hadn't had one since the virus broke in March of 2020. And our true north as investors has always been, if we're not entering a recession, it's extremely rare to see a bear market or 20% drop in stock prices if we're not entering a recession. Right. There have only been 3 times, Hank, since World War II, where you've had a 20% drop in stock prices in an otherwise booming economy. But unfortunately, Hank, to your point, 2 of those were in the 1960s with the Bay of Pigs and the Cuban Missile Crisis, and then also in 1966 with the invasion of Hanoi. Both of those spurred the concern of the start of World War III at that point in time. Yeah. Again, only time will tell on this one. We have our technical disciplines to help get us out of the way just in case. And they're starting to get close to firing here, Hank, that I think some of these concerns, depending on what Putin's ultimate goal is, if it's just Ukraine and it's not further westward expansion, that probably is it. This probably looks like the prior charts that we just studied, right, which says that there's an initial sell-off because of the uncertainty, and then you focus back on the economy.
Yeah, it's a great point, and we're going to take a quick break, and when we come back, I want to delve into that a little bit more, because you covered a lot of ground there that I want to dig down a little further into. But first, we'll take a break. Join us here. We'll be right back on the Retirement Report.
You've been smart and saved for